Welcome everybody. Tonight, I'm so excited to be here talking about the #1 innovative tax credit available for America. This credit is not new. It's been around since Reagan's been in place, but it's something that is overlooked and it's not on the front page of the tax code. Now, if this is your first time hearing this credit, I'm going to make sure that I provide this information in layman's terms to you. And if you're more advanced in this tax credit, I'm going to make sure I give you information to help you advance as well. When it comes to the tax credit, it took me many years to figure out this one line. It's not about what you do, it's how you do it. So it doesn't matter what industry you're in. It doesn't matter what the outcome of the product is. It doesn't matter if it's physical or not. It's the process of how you do the tax credit. Now, when it comes to research and development, research and expenditures, often our minds go to white coat laboratory science setting. That's not necessarily the case at all. The settings are very broad. There's actually not an industry that I could exclude. Even a service-based industry could potentially be eligible for the R&D tax credit. Now, first we have to understand the difference between deductions and tax credits. Deductions are offsets to operating business income. Income is going to be your revenue, and then below that, you're gonna have offsets for deductions. That's gonna include your general business operating expenses like your rent, your utilities, your payroll, contractor costs, supplies, computers, equipment, etc. That's going to be normal deductions. That offsets the income that you make. The income minus your deductions equals your taxable income, right? That's going to be the bottom line. Now, there's a difference between a tax credit and a tax deduction. Often we hear about tax deductions, but what is a tax credit? A tax credit could either be refundable or not refundable, and it could dollar for dollar offset tax liability that's actually owed. So if you had taxable income at the bottom after you took away all of your deductions and expenses and you subtracted them from your revenue, which is your income, and you were left with taxable income at the bottom, that is going to be what can be offset by a tax credit. So if you had $50,000 of taxable income and you found a $25,000 tax credit, you can wipe your taxes down by $25,000 and only owe $25,000 dollar for dollar with a tax credit. Now, when it comes to the R&D tax credit, this is an American-based innovation tax credit. It's meant to incentivize people to create products here, and it's meant to push out new ideas and keep us innovative. There are plenty of other countries that also incentivize research and development, but how they do it is different than how we do it here in America. The IRS requires something called a 4-part test. Now, I'm going to walk through this with you so that you understand it, because it wouldn't be the R&D tax credit without the 4-part test. It goes hand in hand. It's like peanut butter and jelly. We have to talk about it, but I promise you this will all make sense soon, so bear with me and let's get through the 4-part test first so we can talk about the technical aspect. What is the 4-part test and how does it work? Number one, the first part of the 4-part test is something called elimination of uncertainty. And what is this? This means addressing technical challenges and resolving uncertainty. So if you have a mobile app and you're creating it and there's a UI, which is the interface and what it looks like, and you have certain aesthetics on there, let's say you have black, yellow, and gold. You look at those aesthetics and you say, okay, I'm going to change them now to blue, green, and black. Once you do that, there's no uncertainty involved because you know the outcome's going to work. You've already developed the app. It's just an aesthetic change, so there's no uncertainty. You have to do something more substantial than that for it to be considered uncertainty. You know the outcome is going to work. It is just a minor change. So you're not meeting the task for eliminating uncertainty. Instead, you're just making an aesthetic change. Number two is going to be permitted purpose. What is the purpose of the activity that you're doing? This is aimed at improving processes or products, software. It could be techniques or formulas or creating new inventions. One of the key words here is processes. People hear R&D, again, they think laboratory setting. They think something really science-based, not necessarily the case at all. It doesn't even have to be a physical product. As I mentioned, it could be technology-based, which is intangible. It could be engineering. There could be manufacturing. It could be all different things, fashion. It could be even a service-based business that has some kind of technology involved. But there could be process improvement in addition to product improvement as well. Number three is going to be the process of experimentation. This is where testing gets involved. Now, when you hear testing, it can sound intimidating. You might think of a physical prototype. You might think of sending things out to a laboratory, again, to get some kind of technical testing done by a third party. Now, that doesn't necessarily need to happen. It's pretty broad when it comes to experimentation definition with the R&D tax credit, but there has to be a level of experimentation that's done, and it's usually, they don't want to see it work out on the first time, so trial and error is best. When it comes to experimentation, if it's a physical product, there can be prototyping, there can be physical products and iterations made in advance. If it's technology, there's going to be many iterations of beta testing that happens in advance. Now, if you're an engineer, you might utilize software and different types of technology testing, like building out different types of engineering systems, CAD programs. And if not, maybe you're even trial and error testing on pen and paper. That's also possible as well. The fourth part is going to be technological in nature. What does that mean? That means there has to rely on some kind of science. Now, in order to rely on a science, again, it doesn't mean white laboratory setting. It could mean chemistry, which could be a food product. You could be making cheesecake or sandwiches and not have any degree in anything science, not even graduate college or high school, but instead you're creating some kind of gluten-free bread that you've never done before, but it's relying on a science, which is chemistry. Chemistry is the science behind food. Now you can, for a software company, you might have different types of engineering for software engineering involved, but you do not need to be a developer with some kind of degree. Instead, you can be doing this yourself. You can be self-educated, but it's relying on a science is the point. Whether you have a degree in a science or not, it has to rely on some kind of science. So examples that are very common will be engineering. You'll see computer science. There'll be physical or biological sciences as well. That 4-part test is a requirement. That is what we're testing the entire time as we're asking questions, looking at numbers. The 4-part test is always in the forefront of our mind as we're going through the R&D tax credit. So as we go through this, I'm going to relate that 4-part test into real life examples. When it comes to the industries, there's so many, you guys. There's no industry that I would say is completely out. I could never tell you like this one industry is out. Service-based businesses is going to be a lot harder, right? I'm sitting here owning tax firms. So you might say, how could you get R&D tax credit for that? Guess what? We're building apps. We're doing things behind the scenes. We're building out technology. So just because my services are service-based doesn't mean I'm not providing R&D on the back end. So that's why I say there's no one industry that I ever rule out. There are industries that are more dominant and condensed when it comes to R&D. An example of that would be manufacturing. Manufacturing is definitely a more condensed industry. Generally, when you're making widgets, you're generally improving them as years go on. You're generally not doing the same thing over and over again. Maybe you have a catalog of 10 different products to start, but eventually you generally, if you're going to stay in business, you have to either grow, enhance, or the business generally dies. So you're going to enhance processes, even if it's not the product themselves. You're going to be looking at different technologies, maybe robotics to make it versus people. There's going to be process improvement for sure. Again, if you're staying at the same, you're going to be outbeat by your competitors. So manufacturing is a big industry. In addition to that, engineering is a great industry. Even though there might not be a physical product, they're the ones behind the scenes creating those processes. They're the ones experimenting on the technical software behind the scenes and creating the designs. So there's a level of testing involved there. Software, there's so much when it comes to technology. We are in a booming world with AI and everything that's going on right now. Tech is major. Every single one of us should be paying attention to it and seeing how to innovate, even just for our own personal use, efficiencies, etc. Technology is going to be huge, whether you're building a mobile app, whether you're enhancing software within. Now, generally, if you're building software to manage like HR and administration tasks, that will not count. But if you're building it to, again, improve processes, maybe a new product for our client, those are all things that you can utilize as part of the eligibility for the R&D tax credit. Agriculture is big too. So don't think just because you're farming, a lot of people, we actually have more than you would believe. We have a lot of people in the farming industry that will call us up in the agricultural industry, and they'll be creating different products to enhance maybe some of the farming techniques that are available for sustainable solutions and making things more green. Those are all things that are going to count, those activities. And life sciences. So we can get into the technical stuff when it comes to medical, life sciences, aerospace. It could go on and on. Again, there's not one industry that I would say that is excluded from this, because it's not about what you do, it's how you do it. Okay, so let's talk about how to calculate the R&D tax credit. So generally there's 3 things that go into it. Number 1 is going to be wages. That's your W-2 employees. That could be you paying yourself and anybody else. That's the W-2 employees. The second thing is going to be your contract research. So that's going to be 1099 people. That's going to be someone that you hire to take on some of the R&D work. A lot of times that's very frequently happens. So maybe I have a mobile app that I'm building out, but I am not a software engineer by any means. So instead, what I'm going to do is I'm going to hire an engineer to help me out. They can take on that contract research and they can do some of that development, because that's not my forte. The third thing is going to be supplies. Supplies used in the R&D, that's cost. Once things become operational, let's say you're making a widget again, and the widget is done and it's operational, meaning like you're selling it and you're getting SKUs and orders and you're selling them by the dozen and etc. No longer is it considered R&D. It's until everything that happens before that process is R&D. So I have startups that will be funded startups. Maybe they get some kind of big SBIR loan, or they have some kind of funding and capital, and they'll have maybe a handful or two of employees on, but they don't have revenue yet. And all of those expenses that generally are going in are generally 90% of it is going to be for R&D if they're creating something. We have a company that creates a vegan leather. We have companies that have things that one of the first, it's called a microwave, but it really is something that communicates with, it's a communication device with outer space, and it's been around for 50 years. So we have super technical products to companies that make food products and cheesecakes, and it goes all over. But it's the products that go into the testing, it's that preliminary stuff, and while they're creating new designs, while they're creating a new offering, it's all of that activity that goes into it prior to becoming operational. Once it's operational and you're replicating it and you're selling it and it's good to go, that's not R&D, you guys, anymore. Until you enhance that thing again, that's R&D. And the best part is you do not need to be successful in your activities. So as we know, as we test things out, it's not always a home run. Of course, we wish that everything would work out every time, but it's not always the case. All of your efforts, you get a big pat on the back here because it can go into a tax credit for any money that you actually spent. So this is a great way to try to recover some of those expenses and utilize them for future things that you have building out. I will jump into live examples with you so you can see real numbers. But for high level right now, generally when we call expenses and qualifying activities when it comes to the R&D, that's the things that truly are R&D. So when it comes to payroll, we'll look at payroll. If there's 10 people on payroll, we'll want to know, what does each one of them do? What is their title? What are their roles and responsibilities? And based on how they record their time, maybe they time track and there's job coding and they're very specific on their time, and maybe they're not. And then we'll have to do more interview processes and determine what everybody does and talk about what they've done during that tax year. And then we determine percentages. So maybe me as the owner, I'm more of the innovator and maybe more of my time goes to new creation. So maybe I'd say 65% of my time. It's not 100% of my payroll though, because I'm also doing sales. I'll also do administration. I'll also do relationships, right? And other things that don't count necessarily as R&D. But as long as you're doing predominantly R&D activities, the time that you allocate in there that goes specifically to those expenses, that's how we look at wages, whether it's time tracking or it's going to be conversational from the data that we get. And then when it comes to contractors, if the IRS was ever going to audit you, and again, guys, this is a very, very low audit risk. It's the same risk as filing your tax return, which is very low. But if you were ever to get questioned on anything and you looked at contract research expenses, which is again 1099, and that would be people that you would outsource maybe for the recipes that I mentioned earlier in the food products, that I would send that out to somebody that specifically knows how to work with gluten-free food, because I've never done that before, and create new tastings and recipes. So someone like that, they'd want to look at a contract. They'd want to see that they truly are taking on the R&D portions of the work, that you're outsourcing that, and you still get to count that, but it's discounted. You get more credit if it's yours, meaning your W-2s. And when you go look at contract research, they start at 65% of whatever the cost is before we even see if it's 100% qualified of that 65%. So there's a little discount there. Once I get into the examples, you guys are really gonna feel good about understanding how this works. But I have to understand the full picture before we can jump into that. So as I mentioned, the Big Beautiful Bill has provided incredible advantages when it comes to the R&D tax credit and for businesses in general. Now, previous to this, we'll talk about some changes that have happened, but there's different types of actually R&D tax credits you can take. People don't realize that if you've never done it before, but there's an income tax credit and then there's a payroll tax credit. So what I'm going to show you is the differences between the two, because some of you might be on here like, I only have a few employees, or I'm just getting started, or I don't really have revenue to offset this year. What's the point of doing this? Now bear with me because I'm going to show you some things that are going to blow your mind, because this is really incredible. I've talked to top R&D experts in the field that I'm friends with for many, many years. We go there on a lot of boards and different things. It's one of the funnest things when we get to share this information with you guys, because again, it's not on the front page of the tax code. So it does take digging. It does take passion. It does take investigation. And there's a lot of back and forth to understand these things. So let's start with the bigger one, which is the income tax credit. So what this means is it offsets your income taxes. So generally, you have to own a business to take the R&D tax credit. Now there's all different types of businesses. There's flow through entities like S Corps and LLCs. And then you might have a C Corp, which is not a flow through, right? But essentially what happens is for the flow through entities, the same way that income would flow through to you and you would be responsible to pay taxes on that, the tax credit follows the same suit. So the tax credit also flows through to you and can offset your personal income taxes in addition to the business. It's derived from the business, but the business moves to your personal and it can offset what portrays on your personal. So now how does it work? The income tax credit has no cap, which means that I have clients that we get them over $1 million a year in R&D tax credits. The big companies like GMC, BMW, look at the big car manufacturers, they plan their entire year around the R&D tax credit. This is available in other countries too. America is what we're talking about today. This is the credit that's here. Other countries, it varies. Everybody has their own thing. There's actually 36 states in America that also have their own state tax credits, which we'll talk about as well. State R&D tax credits. And those are all calculated differently. No two credits are the same. But the federal income tax is where you get to offset dollar for dollar any tax that's owed. So if I found you $50,000 in a tax credit and you owed $100,000 that year, the R&D tax credit can dollar for dollar offset $50,000. So then essentially you will only owe $50,000. That's why credits are so powerful, because it could be dollar for dollar. If you owed $60,000 in tax credit, $60,000 in income taxes, and you had a $50,000 tax credit, you would only owe $10,000 at the bottom line. So because there's no cap, your tax credit could be, you're a major company talking hundreds of millions of dollars, it could be a $20 million tax credit, right? Like there's no cap on the income tax, and that's what makes it so incredible. In addition to that, if you don't need it, tax credit has a dollar for dollar offset your current year taxes if you're doing a current year credit. Now, this is not a refundable credit from a federal standpoint, but what it can do is it can carry forward for up to 20 years and actually could go backwards as well. And you can go backwards and amend returns for up to 3 years, and that's where you can go into refund land and see if there's any refunds that are available. So I have clients that will be in a heavy R&D year and we'll do the R&D tax credit, but they'll say, my expenses are really, really high, Danielle. Like, I don't think I'm gonna actually owe any taxes this year, but it's still worth doing it because then they get to utilize that for going forward. As long as you know you're gonna stay in business for a few more years and you plan to owe money with taxes, which means that's a good thing, you guys. That means you're making money, right? It's a good thing to have to owe taxes. This is a good conversation to have. Everyone on here is interested in an offset, which is a good thing. And what's great about this is this can be done on amended returns. This can be done on extensions. So you can do this after the fact as well. It's not something that has to be, the expenses have to happen during the current tax year, but the credit and the process of doing it can happen subsequent. And there's no cap on business size as well. So I'm gonna also show you the payroll tax side. So this is where people miss. You'll hear about the other side, but this is called the Qualified Small Business Payroll Tax Credit. So this is different. The payroll tax credit, there are conditions here. Now, prior to the One Big Beautiful Tax Bill, the company had to be 5 years old or less. Now, one of the really great advantages of this is this has got expanded to 10 years old. So a company can be 10 years old and qualify for this. And what this allows you to do is if you don't have income tax to pay, you can now offset your payroll tax. So my companies that are not generating income to pay at the end of the year now have a choice. If they're less than 10 years old and they're 25 million or less in average gross prior receipts for the past 3 years, they have a choice to offset payroll taxes or income tax. Now this, when I say payroll taxes, this can offset your Social Security, which is 6.2%. And most recently, they just added Medicare tax at 1.5%. So what this means is, same example, if I had a $50,000 tax credit and I put that into a bucket to offset payroll taxes, I do not have to pay payroll taxes anymore on Social Security for any of my employees as an employer, none of my employer taxes or Medicare until I utilize those funds. And now all the payroll companies know about this. The big companies, the Paychexes, the Gustos, all of them. You do this, you fill out a form 6765, the same form you would fill for your income tax. It's just a different section at the bottom. And now you have a choice to utilize this for payroll. Now, previous to this, there was a cap of 250,000. This has also got expanded to 300,000. So like I said, the income tax has no cap. You could be a business of any size. You could have a credit of any amount, but here it's different. The max is 500,000, 25 million average gross receipts for the past 3 years, company 10 years or younger. But now you can do both. This is one of the most incredible things is you have a choice. So if your company's under 10 years old and you meet all of those standards, a really strategic advisor would then look at everything you have going on and say, well, we're going to have tax exposure of $25,000 from an income tax standpoint, and we don't really need the rest of the credit yet. So we have a choice. We could either roll that forward from an income tax standpoint, or hey, this is the government. They'll never give you a free loan. We might as well use it, right? That's what I would suggest doing. If it's available and you have payroll, use it. Use it against your payroll. If you're eligible for this, why wait? Of course, there's strategic planning and things. As I say that, it's a general statement, but again, they'll never give you a free loan, so why give them one? So when it comes to the payroll taxes, that's the big difference, is you just have those standards that you must meet, and from an income tax standpoint, there's no cap. It's really, really incredible tax credit. Remember guys, all the things that you're normally utilizing in your operating expenses, you still get to write off as a deduction. So your payroll is still a write-off. Your supplies, still a write-off. Your contract research, 1099 people, same exact number of write-off, no longer gets compromised. All of that normal write-off. In addition to that, all those things that you already are doing that you have to do to operate business, most of those are gonna be requirements, right? Now we get to squeeze them out and turn them into a tax credit, dollar for dollar, without compromising the deductions. This is why it's so powerful, you guys, because of the flexibility in here and the fact that you're already doing it. If you're already doing it, you should absolutely be applying for an R&D tax credit. Now, I mentioned before that there's 36 states that also have eligibility for the R&D tax credit. For those of you that can see my screen, anything in dark gray means that there is no tax credit. So where there is no R&D tax credit, there's certain states, which again, you could still get the federal. Federal is federal, that's everywhere, right? Federal is federal, that's not state dominant. But examples of states that do not have an R&D tax credit would be North Carolina, Tennessee, Alabama, West Virginia, Oklahoma, South Dakota, Wyoming, Nevada, Washington. Those are just some examples of states that don't. But again, the rest of them do, and each tax credit is different. The way that it's calculated is different. And I'm going to show you one of the best states to get the R&D tax credit in. So here's the examples. For those of you can see my screen, this is going to look like a lot, but there's a lot of information on here. It's very important. I'm going to walk us through this. This is where things are going to start to click. Case study number 1, cupcake manufacturer. Not about what you do, it's how you do it. Those cupcakes that are sitting on the store at Publix and Stop and Shop in your local food store, as they're innovating, as they're creating things, could potentially be eligible for the tax credit. If they're making the same chocolate frosting, vanilla cake, cupcakes for the past 20 years and there's nothing new about it, then no, that's not going to be innovation, right? But if they're now making them, if they're improving the recipes, if they're figuring out frosting and filling stabilization testing, if there's process optimization with mixing and baking utilizing new machines and making things more efficient, if they're scaling it from a test kitchen to production, that's going to require testing involved. If there's reformulations for clean labels or allergen control, right? Going to gluten-free or keto, or getting into Whole Foods is a whole different label and requirements than it is in regular food stores like Costco. So to meet those criteria, you're going to have to do different activities that you didn't do before to improve processes, to create new ones, to have enhanced testing, and all of that counts. Now, testing could be everyone around you physically testing it, benchmark testing, eating it. This counts. Testing counts. You can taste a cupcake and it counts. Now, there could also be more sophisticated testing. Like if you're going out to get into food stores, they're going to want different types of testing, like market or consumer preference. And there's also going to be different types of quality control enhancements and requirements when it comes to testing. What doesn't qualify is post-production testing, anything that's happening after you produce it. If you're copying competitor products, like just utilizing their ingredients and now just figuring out how to mix it your own, that's not going to count. So again, there's got to be market and consumer testing for preference. It actually does not count as part of the R&D tax credit. So there's got to be more testing that happens as well. They don't want to see just taste only. There has to be other levels involved when taste counts. Taste will not hold up enough in itself. There has to be some kind of level where maybe you send it somewhere or you get some kind of ingredients, and some kind of testing from the outside would be very helpful in this scenario. This is a true custom of ours. We round the numbers, but every single example here are true customers. So this one is a $3 million gross receipts. They are based in North Carolina. They are a cupcake manufacturer. We also, again, have cheesecake manufacturers and sandwich manufacturers as well. They are looking at federal because they're in North Carolina. That is one of the states. There's no R&D tax credit from a state standpoint. So what goes into making up their R&D tax credit? Their payroll. So who's on board on their payroll? They have like an R&D person that they designate, the R&D manager, and that's the person that comes up with the new recipes all the time. And then they have a head baker. They have a guy he's technically business development sales, but he's gathering information from all of the consumers and customers and also from the strategic partners. And then he's working with them, and he's more of a highly paid employee. So he helps get that payroll up to that $400,000 number. And then they have lead producers on the bakery line. So they have a big manufacturing shop in the back where they make these cupcakes in-house. They have a ton of equipment. There's a line of people that will be doing things by hand, but a lot of it is generated through equipment now, and it's mostly being monitored by humans. And they probably have about 200 employees, but out of that payroll, about 400,000. A lot of them are lower wage paid hourly because they're in a manufacturing shop working at minimum wage. But for their more strategic people, they're leaders, they're foremans, those people that are involved in the testing, the prototyping, that have a say in the brainstorming, their payroll goes into the R&D tax credit. Contract research is number 2. So that's anyone that's 1099, and that's going to be research that's also sent out. They specifically gave out part of the work for a recipe enhancement for a gluten-free recipe. And also they tested out shelf life enhancement to try to get the shelf life longer for their products, to enhance the cupcakes from lasting 7 days to lasting almost double when they figured out shelf life testing. And another thing is supplies. So now what happened? They had $526,000 of qualified R&D. That's eligible expenses is what that means. That's not all of their expenses. That's their expenses related to R&D, rounded, $526,000. So we were able to generate a tax credit of about $82,000 for them. So how does that work? Their taxes due were about $75,000 from a federal standpoint, income taxes. And we broke out their tax credit because the company was less than 10 years old. So they took $62,000 as an income tax credit, and then they took $20,000 as a payroll tax credit. So they owed $75,000, if you're following me on the right here, $75,000 they owed in income taxes. They took the $62,000 to offset it, and the taxes due were $13,000. And the same thing when it came to payroll. Remember, payroll, you can offset any type of Social Security and also Medicare as well. So they only owed $11,000 there, but they had a $20,000 that they offset to payroll tax because they know that they have, again, a higher payroll. So they have a carry forward credit of $9,000. The income tax credit can go forward for up to 20 years, and the payroll tax credit can go forward for about 5 years. Case study number 2, steel manufacturer. So here we have a steel manufacturer. What my customer does here is they develop high strength alloy process testing. They make different types of steel. They do rails, they do structural steel, they do all different types of steel. And quite frequently, they're doing different types of testing when it comes to the strength, the standards. They do a lot of custom work. They do have a catalog where you can buy their railings, and they do residential, and they also do commercial. They do some handicap stuff as well. So they do have their SKUs. They do have their things that are no longer R&D. Because of that, they're handling different type of material innovations, designing new fixtures. This is a bigger company, you guys. This one's about 60 million in revenue. In addition to that, contract research. So they outsource some of the engineering when they have complex products or things that they don't do. They'll outsource some of that work. We average about $300,000 in last year when we did this for them. And then they have supplies, right? So a lot of their supplies, it's hard for them to break it out. You see this a lot. Like this, I actually think we can be getting them more than this, but because this was the first year we did it with them, it's hard to break out what supplies are initially if you're not set up for success. And that's what we do, because the same vendors they often order from that they'll be doing prototyping testing will be the same vendors that they order from for doing regular operational, like their actual products. So it'll be the same vendor. So unless they're job coding and tracking correctly, it's hard sometimes to break that out. So I find a lot of times the cost should be a lot greater than it is. And then we work with the clients after the first year to implement systems and processes to try to enhance those numbers for going forward, right? The goal is to make this non-business interruption approach. We sit there and pull numbers for the R&D tax credit all day and involve you guys, it's gonna be like pulling out your hair. You don't want the tax tail to wag the dog. And same thing when it comes to strategies. You never wanna implement a strategy that's more work than it's worth. And that number and time is different for everybody, but time is our most valuable asset. So in this example, Arizona, here we go, Front runner, taxes due from a federal standpoint was $200,000. There was a refund here of about $185,000 from the federal standpoint. And then they owed about $15,000 that was due from taxes, right? Dollar for dollar wiped it out. $185,000 went against the tax liability, dollar for dollar. But they actually get to get a refund because their tax credit, they actually get to do it at 24%. It's even a higher percentage. Their refund they were looking at is $320,000 because they found a credit for $420,000, and the refund will apply. But again, there are limitations. So in this example here, they would have had to be 10 million or less, just like how I gave examples for qualified small business earlier. Arizona also has something like that as well. They want to see you 10 million and less. So even though they could have got it here, they couldn't get the refundable credit because their revenue was too high. So that's where every state is different. There's different limitations, but Arizona is incredible in that format because there's no other state that does it like that. This is another client of ours that's developing a digital health and mobile app. They're about 2 million in revenue. They're about 8 employees. It's a really techie company. They're developing, it's very AI driven. They're doing things to interpret heart rate. They're tracking things like sleep, oxygen levels. Think about the Fitbits and the Apple Watches and all those things. They have something completely different going on, really advanced from a technology standpoint. And they weren't operating under income for the first few years. So they were looking at payroll tax credits initially because they didn't have, it was very tech heavy and very beta testing in the beginning before they were able to launch, right? And that's where all of that counted and they were able to offset against payroll. Now what they're looking at, between their software developers, they have data scientists, and they have testers that are involved as well. Their wages that they're paying people around $400,000 for qualified R&D expenses. If you're building a mobile app, most of the people on there are going to be qualified. If you only have 8 employees, your first hires are generally not going to be HR. You may not be in compliance with all the things for HR, but instead, your app's going to work pretty darn well, right? Then from supplies, you're going to have like the platforms in the background, cloud server costs, test devices, beta materials, and then from contractors, you may utilize, maybe they didn't have somebody initially that was specialized in a certain type of AI. So they had someone that is their in-house AI manager, and then they outsource some of the AI to a model consultant, and they did that for about $50,000. So on average, rounding numbers, true client here, about $500,000 they're looking at as QREs, which means qualified research expenditures, right? So the federal here is about $50,000 that they owed, and they got a tax credit in this example more than they needed of $105,000. So what happens? They, again, have that choice where they can carry it forward or they can offset it against payroll because this was a newer company. Originally, they offset against payroll, and this year they decided to carry it forward. So now, because they're expecting to be very profitable next year, now that they've launched, they're out of beta, they're ready to go. So that's $65,000 is just like in the cloud for them. It's in their toolbox of tax credits, and they know that whatever happens next year, they have a $65,000 tax credit, dollar for dollar, to offset their bottom line taxable income. The other part that they did is they have a state credit as well. They were in the state of Florida here, and for the Florida credit, they were able to get $22,000 for the state of Florida, and the taxes due there were $50,000. So they dollar for dollar offset that again. I want to also talk to you about some of the changes, and this is for anybody that's heard rumors about the past, because R&D has gotten a bad rep in the past few years because there were changes after the Tax Job and Cuts Act, TJCA, sunset. Now things changed and there was some amortization that had to come into place. So like I mentioned, this is powerful again because you can, those examples I gave you, if your tax credit's $100,000 in the current year, you can offset $100,000 if you have the taxable exposure. If you were in the past 2 years, you would have had to amortize your R&D expenses, your R&E expenses over a 5-year period. Generally, it wasn't always worth doing it. It depended on the case, but it could actually create more taxable income for you because the R&D tax credit is something that's voted into permanence, unlike other tax credits that are just voted on year by year or have a certain expiration date. The R&D tax credit has been around since Reagan's been in place. This is nothing new, you guys. This is why I'm saying it's been written in the tax code. In 2015, through the PATH Act, it was actually voted into permanence, meaning that it can never go away. But what they can do, the government can be sneaky and find ways to offset it, even though they can't touch the tax credit itself, and that's what they did. They defined a new definition of research and expenditures. So any of those normal expenses you were doing anyway, if they fell into that category, you had to then amortize them, which means like a depreciation, put them into a bucket, and then divide it by 5. So no longer could you deduct if you had 100,000 in payroll for somebody that was considered R&E. You wouldn't just get that as a deduction anymore. You now had to divide that by 5, which again could create exposure for you, because that payroll that you're paying, you don't get that full write-off. It's amortized over. So really after year 3, year 4 is when you would feel that effect, because you'd have cumulative amortization. Good news, I'm going to tell you how to recover that if that happened to you. I have one more slide for you on that. But there is a retroactive business benefit where you can go back to 2022 and 2024 when they had that in place. So there's a bad rep, because rumors went around and there was truth to it. There was a big misunderstanding. People stopped doing it. They didn't understand what happened, how to account for it. Are you still eligible for it? Does it make sense? And now looking back, you can go back and make those judgment calls if you did amortize it, or if you want to go back 3 years and claim the credit because you didn't. And people might say, oh, it's not worth it because it ends up making you owe money. That's all bogus. It's not true. 2 things are going to happen. You have a tax credit and you either can use it or you can't. So let's jump into the before and after, just to do a side by side here. This is the capitalization for 5 years previously, and now you can deduct it in full again. Also, this is a big one. The way that the credit is calculated, without getting into the specifics, has increased from something called Alternative Simplified Method, known as ASC, went from 14% to 20%, which will enhance the amount of the R&D tax credit that you were able to take in the past. And then the caps of payroll, as I mentioned before, for this qualified small business went from 250 to 500,000. And then also same thing with, it had to be 5 years or less for qualified small business to offset payroll. Now, 10-year company. How can I go backwards if I had to amortize, or if I want to do this tax credit for the first time? If you're going to go backwards, it's going to require amending your business tax returns. And if it's a flow-through entity, you're also going to have to amend your personal tax returns. Both of those things have to happen. You can go back if you've amortized and you fell into those sunset rules. There is a deadline. It has to be done by July 1st of 2026. And you have a choice then to fully use that unamortized balance in 2025 as a major lump sum, or you can take it over 2 years, over 2025 and 2026, if you don't have that much tax exposure. I want to let you know that, of course, there is the chance that they can ask a question about something else. Now, most of the time it's clear and it's fine, and they won't, but you do provide the opportunity of what's called a desk audit, where they can ask a question about something else. So if anyone tells you to go backwards to claim returns, make sure you feel comfortable that the returns that you filed in the prior years have information on it that you'd feel comfortable answering a question about. Now, that is me just being as truthful as possible. For my tax nerds out here, or people that want to fall asleep at night, here's your forms. Your forms are going to be Form 67, 65. That's the main R&D tax credit form. You can look it up. That's where everything gets filed on. It's one extra form on a tax return. Now, when you're doing this, there's no application ahead of time. It's one extra form on a tax return. Your accountants will fill that out. It will automatically be part of your tax return. You will get the credit. There's no application. If you file an R&D tax credit, you will get the tax credit. Now, just make sure that you are doing everything legitimately. Make sure you're doing it from an eligible standpoint and from a fiduciary standpoint, the information you have in there. There's different forms. If there's payroll tax reductions versus offsets, and if you're looking for retroactive, there's something called a Form 3115, which is accounting method changes. Now, people will ask me what's required when it comes to doing the R&D tax engagement. What does this look like? The information that we would need would be the prior year payroll information. We'd want to look at year-to-date payroll information. We'd want to look at job titles. We'd want to know who does what. And we'd want a few lines of a description of each person. We'd want to validate that with W-2s. If you have contractors, we'd want to look at contractors. We definitely wouldn't pull all of the agreements, but we may make some selections where we'd want to look at a contractor or two. And then if there's time tracking involved, that's where we're going to need more information. So if you're tracking time by the hour, by project, by what the materials purchased, etc., that's the IRS's favorite, most audit-proof way. But it will take information that it will be more on the back end. We'll have to get that data dumped from your system, which generally is not complicated. It's usually just providing it into Excel. And then we manipulate the data, and then we'll ask questions based off that information. During the 4-part test, is there a duration required by the IRS? In other words, if it takes more than a year to test and experiment, will it still qualify? Also, if you get help from AI for the testing ideas, is that allowed? Everything's tax basis. That will still count. The answer is yes. but whatever activities happen in the tax year, so let's take 2025, for example, look at January 1 through December 31st, whatever happens in that tax year is what will go on that tax credit. Now, if it's not done yet, which is very, very, very frequent, it's very frequent that something doesn't start and stop in the same year from an R&D standpoint. Now, you will get the benefit in the future years. It's cost. So if your wages, from January through March in 2026 go into this, those wages will be considered 2026 tax credit. So yeah, you can totally get testing from AI for sure and ideas. Now, when it comes to counting for research, I want to be careful. Like if you're using ChatGPT to answer questions in like deep research mode, that may not count because it's going to be considered more administration versus research yourself. Does the R&D tax credit apply to companies, including small businesses that are defense contractors that are awarded R&D contracts from DoD, especially with DARPA, Navy Research Lab, Air Force, etc.? So there are things that have to be included from the R&D tax credit when it comes to the calculation. Government contracts are one of them. So we have a lot of clients that contract with DoD, which is Department of Defense, and other government agencies. And what we do is we'll analyze, because they're generally not 100%. They're not 100% funded from DoD, but instead they'll have government contracts in addition to the regular contracts. And we will have to take out like the payroll that's specific to that. We'll have to make sure it's job coded correctly, and we'll have to take out whatever's coded. Like if you get a grant, that would also have to come out, because with a grant, you have to do different types of reporting, like where you'd have to put in payroll, you'd have to put in expenses for grant reporting. Let's say you got a grant of like $50,000, and part of the contingency is that you're going to report twice a year on the grant. Then the payroll that you're utilizing the grant for, and whatever the grant was for, that would also come out of your calculations, which would be your eligible activities. It doesn't offset the R&D tax credit. So if your R&D tax credit is $100,000 and your grant is $50,000, it doesn't wipe it out like that. It's like the eligible activities, like your payroll, whatever the grant is used for. Same thing with the government contracts. That type of stuff, we'd want to look at keeping that separate. If you're 100% funded from defense contracts that are government, then you probably wouldn't have an R&D in the current year. You could look into the state tax credit to see if there's any eligibility there, but from a federal standpoint, it wouldn't be eligible if it's just government contracts. Can you use R&D tax credits in addition to the 100% write-off, Section 179 depreciation for purchasing software, crypto, blockchain space while you're a node owner in developing AI? Can you use the R&D tax credit on something that you're going to write off 100%? Now, this can be something like what she's mentioning here is bonus depreciation. So this could be equipment as well. So I mentioned that one of the best things about the R&D is that all the deductions you normally get to take as well, and it squeezes out this major tax credit. But anything that's depreciating, like a depreciating asset, like if you have a car, like that's going to be something, or a piece of equipment, or if you're 100% depreciating crypto up front, then that would be removed from the calculation from the R&D tax credit. Now, again, everything else that goes into it, the exercises, the payroll, the people, all those things can still be included. But like the piece of equipment, or again, if it's Section 179 bonus depreciation, whatever you're depreciating upfront, that gives you 100% upfront. So that will not be included. I have a few people asking, like, you get the credit and deduction. Yes, you get the deduction of like the payroll, the wages, the supplies, all that's normal deductions. In addition to that, it squeezes out a tax credit. You get both. Yes. For CPAs, can the creation of AI employee to replace an admin employee be considered R&D? There is a lot of testing to see what it takes to be replicated by AI and what tasks still need to be human. We'd have to talk more about that, and that's why I wanted to answer that, because there's some that are not just straight. So far, I've given you all yes or no's, and this one is not a straight yes or no. I would say it's possible, but I'd have to know more. And what I mean by that is it would depend on the usage of the AI. So if it's just for employee replacement, then we'd be looking at improving possible processes, right? But you're doing it in a service-based business. So we'd want to make sure that the qualifications, there's definitely testing involved, all of those things. And you want to make sure you're producing something not just for your own good. Can this be used inside of a ROBS starting this year? Yeah, a ROBS is a C Corp. So why not? Yeah, It is a C Corp, and C Corps are allowed to take advantage of the R&D tax credit. There's nothing on there that says that it cannot because of it being in a ROBS. So the answer is yes. Are there any R&D tax credits for real estate? Investing in real estate? Yes, of course, it's possible. I have someone right now that is handles mortgages, and he's building out a whole system right now with AI, but to produce to other users and an app and etc. But it's based off of real estate. So yes, there has to be something else involved besides like investing in flips and stuff like that. And it can't be for your back end, for your project management administration. You have to be producing a good. I want to thank everybody so much for being here tonight. Thank you so much from the bottom of my heart. I know how hard it is to take the time out, but hey, you guys are killing it. You're one step further than everyone else. You're on here tonight, right? You're sitting here on a Tuesday night, expanding your knowledge, leveling up your tax game so that you can take advantage of these strategies for yourself, or even provide the knowledge to somebody else. Even better. What's better than to give and to serve, right? Thank you so much. Have an amazing evening.